Hi everyone, this is a demonstration of DCF, discounted cash flow analysis. And today I want to cover two things. One, I want to show you how to build a financial model to get NPV and IRR, which is technical processes and calculations. And two, I want to show you how to get an insight through the DCF analysis. As you know, the objective of the DCF analysis is not just a calculation, but we need to have an insightful perspective through the analysis to support the decision makers. Okay, and today I want to demonstrate the sensitivity analysis to get an insight. And today's demonstration is based on the case, and you can refer to the case on the sheet named case, and please go through the sentences for your understanding the background, and take a pause and resume it when you are ready. Okay, now you are ready, so let's move on to the financial model development. Now we have an assumptions. If we introduce the newly launched the lemon champagne conditioner, we can expect the sales revenue in year one with 500 millions. And the revenue is growing up towards 2.25 billion in 7 years, year 7. Okay, and also we have a COGS here. COGS assumption looks at 30% of the sales is assumed as a COGS. And SGA assumptions here, also depreciation assumption here. So depreciation amount should be linked with the capital expenditure. We are now have an assumption that 500 million is required for the initial investment. Also, we have a tax rate assumption here, discount rate assumption here, and also we have an assumptions for the working capital. DSO stands for the days sales outstanding. It is an indicator how many days of the sales the account the receivable balance corresponds to. DPO is an abbreviation of the days payable outstanding. So it is an indicator how many days of COGS the account payable corresponds to. DIO are the same. It's in the days inventory outstanding, how many days of COGS the inventory the balance corresponds to. Okay, so using these assumptions, I want to build the financial model, okay, to get an NPV IRR. So as I said, the final output should be the NPV and IRR, right? So NPV and IRR should be the final output. That's an objective of this analysis. So in order to get these two numbers, anyway, we need to have a free cash flow. And free cash flow can be calculated as the EBIT multiplying 1 minus tax rate. In other words, the operating income after tax, or EBIT after tax, or we can call it EBIT, earnings before interest after tax. Anyway, after tax based operating income, that's the starting point. And we have an adjustment items. One is the depreciation add back. Second one is the capital expenditure. We call it the CapEx. And the third one is the working capital change of the working capital position. Okay, so these with these adjustments, we can get the free cash flow. So in order to get the free cash flow, let's start from the EBIT, and we will have a corporate tax payment here. Corporate tax. So we can get EBIT, which is an operating income after tax. Then we will have an adjustment items here. Depreciation, add back, CapEx, and change of working capital. With these adjustments, we can get a free cash flow. Okay, and once we get a free cash flow, we need to convert the free cash flow into the present value. So we have a discount rate here, and using it, discount factor here, we can convert to the present value. Okay, and NPV is a sum of the present value of the future cash flow. So simply, once we get the present value, we can calculate an NPV. And IRR is what percentage of return we can predict from the project. So once we have the free cash flow, we can calculate an IRR. Okay, so that's the logic. Once again, let's recap the processes. Starting from the EBIT, and we multiply the tax rate to get a corporate tax. Deducting the tax, corporate tax, we can get an EBIT, or operating income after tax. And we put 3 adjustments items so that we can get a free cash flow. Now we have a free cash flow, we need to convert it into the present value. So using the discount rate, calculating the discount factor, multiplying the free cash flow and the discount factor, we can get the present value. That's the steps. Okay, so let's move on to the calculations. Okay, so I want to insert the 3 columns here. Okay, and I want to put an year 0 here. That's an initial investment. Okay. Okay, and also I want to have it's an okay. Okay, let's change. It's an assumption cell. So now I'm a little bit modify the worksheet, and basically now we have hard numbers, right? But I wanna put the formula as much as possible, because after completing the financial model development, I want to have a sensitivity analysis. I want to have simulations. I want to change the critical parameters and to see the impact on the NPV and the IRR. Okay, so to do that, I want to have the formulas. Once I change an input cell, the automatically output cell will be simulated. So that's my intention. Okay, so now we have an assumption of the sales here, and the sales amount can be calculated as a multiple of the previous year's sales amount multiplying the growth rate, right? So this 1250, the median of sales, can be calculated as a previous year sales revenue multiplied the growth rate. Okay, so in other words, I select these cells as an input factors. Okay, so once we define the year 1 sales, so let's change from 500 to 300. Automatically, year 2's revenue should be changed, right? If I change the growth rate assumptions from year 1 to year 2, let's say from 250% to 200, automatically changed. So that's an intention. That's an intention. I want to have simulations after completing the financial model. Okay, so I want to have a formula as much as possible. Okay, and okay, so this one should be the same thing. Okay, basically the sales amount is a calculations based on the previous year's sales amount and the growth rate. And I wanna select this year's also as an input cell. And year 4, it's let's say it's an automatic fixed. Sorry, it's 120%, and it's 100%. Basically, they are also the input cell, but yeah, we can say that Okay, so they are the input cell. Okay, 20, 100. Right, year 6, year 7, same as in year 5. Okay, and also we can also put the simulations on the COGS, which is 30% of the sales. Percent of sale, how much? 30%. Okay, I colored for the input cell. So the COGS amount should be the sales amount multiplying the percentage of sales. Press function 4 3 times to fix the column so that I can copy and paste, fixing the differing column here. Okay, so function 4, with the function 4, we can fix the cells or rows or column. Okay, utilize it. And okay, so we now get a gross profit. Very simple. Sales deducting the COGS. And now we have an SGA assumption. Actually, year 1, year 2 is not really proactively we invest. Now we have hard numbers here. But as for the SGA after year 3, this should be the 50% of the sales amount. So I want to use the formula here. 50% sales. Sorry, not here. Yeah. Here. 50% of sales for the year 3. Sales amount multiplying 50%. Press function 4 3 times. So we can get a formula here. Okay. And depreciation amount should be linked with the capex. So we will have a capital expenditure of 500 million, right? So once we make a decision, this capital expenditure will be decided. So 500, and this is depreciated over 5 years. So the annual depreciation should be the 20% of the capital expenditure. So divided to 5. And just, putting the same amount over 5 years. Okay, so now we have a formula here. So now, okay, so we have just, simply same number. But I put in a formula in order to enable us to have simulations after completing the financial model. Okay, so let's move on to the free cash flow calculations. Now we have an EBIT. We need to have a tax payment, and I put here effective tax rate. Maybe it's not a corporate tax payment. Anyway, okay. So currently 40% is an assumption for the tax rate. So 40%, simply the EBIT multiplying the 40%. Okay, so that's an tax. So EBIT, or operating profit after tax, should be the EBIT deducting this tax payment. Okay, one point here. Okay, some people may feel why we have a negative tax payment. Negative tax payment means a tax return, tax savings. We have a benefit of the tax. So, year 1, year 2, the profitability was negative, right? Assumed as a negative. So, generally, if we have a negative profitability, we don't have to make a tax payment. So, they should be zero. So, some people say that, but I dare to have a tax return here. The reason, I tell you the reason. Basically, this company has an existing business, orange shampoo and orange conditioner. It's profitable. So as a corporate, as an enterprise, we need to make a payment of the tax, right? However, we newly launched the lemon shampoo, and we predict the first 2 years, the initial 2 years, we will have a negative profitability from this project. as a company, it's profitable, so we have an obligation to make a tax payment. However, due to the new project, we lose some money, profit. So this means as a corporate, we reduce the profit. So eventually, we will decrease the tax payment amount. So that's the meaning of this tax return. We have a negative profitability from this project. So eventually, we will decrease the tax payment amount, which means we have a tax return, tax saving. Okay, so thanks to the new project, we will have a tax saving. So that's this represents the tax saving due to the negative profitability of the new project. Okay, so that's the reason why I intentionally put the tax return even the profitability are negative. Okay, so now we have an EBIT 150 negative for year 1, 135 negative for year 2, and from year 3 we have a positive EBIT. Okay, and now move on to the adjustment items. We have a depreciation add back assumptions. Just simply trace the depreciation counted in the income statement here. Okay, so just one point for the adjustment here, I want to show you the cash inflow as a positive, cash outflow as a negative. Okay, capital expenditure is absolutely cash outflow, so I express it with a negative. And depreciation add back, it's a kind of add back. It's a positive impact on the cash flow, so I put the positive explanations. Okay, expressions. Now we have the depreciation add back and the cash outflow on the capital expenditure 500. And the point here is the working capital. That's a change of the working capital. So we need to calculate the before having, I don't take any direct calculations here. Before having the change of the working capital, usually I put the working capital position before having the calculations here. Okay, so account receivable, account payable, inventories. Okay, and we have an assumptions of the DSO, DPO, DIO, right? So I wanna put here DSO, DPO, DIO. I want to change the size of the font, and I want to color these numbers because it's not the input. Okay, so now I want to calculate the how much the balance of the these working capital items at the end of the fiscal year. Okay, so we have an assumption 45 days for the account receivable. That is in a position at the end of the year 1. We have some sales assumptions here 500. So just divided by the 365, we can get a daily sales amount. And multiplying the 45 days, we can get the end position of the account receivable of the year 1. So simply 500 divided 365. So we can get a daily sales amount multiplying 45 days. That's an end position of the account receivable at the end of the year 1. Okay, so we do the same thing for the account payable. Account payable is 45 days, okay, of the COGS. So once I have a COGS divided by 365, so that we can get a daily COGS amount and multiplying the 45, which is an amount of the account payable at the end of the year 1. Okay, same thing, inventory, the COGS divided by 365, we can get a daily inventory, the COGS amount multiplying 60 days, which is an amount of the value amount of the inventories at the end of the year 1. So now we can calculate working capital position here. And working capital, how to calculate the working capital, which is a current asset, deducting current liabilities. Okay, so receivable and inventories are the current asset, and account payable is the current liability. So working capital position should be the receivable plus inventory minus payable. That's the working capital position at the end of the year 1. And now we calculate for over the 7 years. Sorry, I made a mistake to refer to the cell. Yeah, I should press function 4 3 times. So that I can copy and paste to referring to the fixed column here. Okay, so that's the position at the end of the fiscal year. Okay, so what we should do is to have a change of the working capital position. So taking the gap between the previous year and this year end. Okay, so simply we have nothing to 68. And increasing the working capital put a negative impact on free cash flow. So simply previous year's working capital minus this year's working capital position. Okay. Okay, so that's the calculations of the change of the working capital. However, I want to put some adjustment here. So just thinking the product launch of the lemon shampoo, lemon conditioner, we need to build up the inventories prior to the product launch, right? So year 1 is the product launch year. However, in order to launch the product, we need to have a pipeline and we need to prepare the inventories. So I have an assumptions as an inventory build up for the pipeline. Let's say the half of the year 1's COGS should be built up at the beginning of prior to the product launch. So let's say year 0, we need to have 75 million of value of inventory. So I want to put these assumptions. Okay. So in that sense, initial year, we need to have the same thing, the previous year, and positions minus this year's end position. We need to have a working capital build up, which requires 75 million cash outflow on year 0, in addition to the capital expenditure. That's the required initial investment. Okay. So now we have an assumptions here, so we can get the free cash flow here. Okay, EBIT plus 3 adjustment items, we can get the free cash flow here. Okay. So now we have the free cash flow. However, one point for the DCF analysis. Usually, at the end of the projection, we will have a terminal value. That's a kind of the standard of the DCF analysis. Terminal value. What is the terminal value? We have 2 options. One, it's an perpetual method. If we have an assumption that the cash flow will last forever, even after the year 8. So example, using this case, we newly introduced lemon shampoo and conditioner, and lemon shampoo and conditioner's brand is so strong. The brand that survived eternally. Even after the year 8, the brand generates the cash flow. So under the situation, we will have a perpetual method. We will use a perpetual method to have the terminal value, which is the cash flow lasting forever after the year 8. And the other one, when we have a perpetual value, year 8 free cash flow divided by discount rate minus cash flow growth rate. Okay, so that's an option 1, first approach. And second approach is a liquidation value, liquidation method. What is it? So if we have an assumption that the brand end at the year 7, okay, the project will be closed in year 7. We have some liquidations. So we close the project, so we don't need the fixed asset anymore. Also, at the end of the year, the projection, we still have the working capital, right? So based on this financial analysis, we will expect to have 305 million of working capital remained at the end of the year 7. How do we deal with that? We collect as much as possible. We collect it as much as possible. Account receivable, what is it? We will have sold the product to the clients, but we will have not collected the money yet. Do we ignore it, just leave it? No, we try to collect as much as possible. So 305 million of working capital should be collected. Okay, so when we take a liquidation method, basically the fixed asset, the cash flow, related to cash flow, if we can set it with price, we can count this cash inflow. And also the settlement of working capital. For this case, we have 500 million of the capital expenditure, but this 500 will be depreciated over the 5 years. At the end of the year 7, we have no value on the book value basis. So it's tough to predict, to sell it with prices. So basically, this time, I wanna fix. I don't wanna put the assumptions of the fixed asset related to cash inflow. Just putting the working capital. Okay, now we have 305, which will be collected. So I wanna put 305 as the terminal value. Okay, now we have the free cash flow assumptions and we have the terminal value assumptions. So now we finally get targeted cash flow to calculate an NPV. Okay. I'm not confident on the typo, so I want to check. Spell check. Oh yeah, growth rate. Okay. Okay, so now we have a targeted cash flow for the NPV calculations. And now, so let's move on to the present value. So we have an 8% of the discount rate. So now we can have a discount factor. The year 0 is as of today. We don't have to discount because today is certain, right? But as for the year 1, it's in the future. It's uncertain, so it's a kind of target of the discount. So how to get the discount factor? Usually I use the previous year's discount factor divided by 1 plus discount rate. Okay. So the year 0's discount factor is 1, no discount. But year 1 should be discounted. Discount factor should be the 0.926. Second year, 0.857. And year 7, 0.583. Okay. So how to get the present value? Simply targeted cash flow multiplying the discount factor. That's the present value. Okay, so NPV is the sum of the present value of the future cash flow. So simply we sum these the row 20, the present value. So NPV should be 318 million JPY. What is an IRR? We can use an IRR formula to target this, row 17. Yeah, some people, target the discounted cash flow. No, never do that. The IRR is stands for what percentage of return we can predict from the project. Okay, so what percentage of return that project generates? So that's an IRR. So we should target the before the cash flow before the discount. Okay, so based on the assumptions, okay, we can get the numbers. The NPV 318 million positive. Okay, positive. IRR 16%, greater than the discount rate. So with these metrics, we can say that this project is worth doing. Just only with this, calculation. Okay. So this is the first part to build a financial model to get NPV and IRR. And I want to talk about how to get an insight or how to support the decision makers through the DCF analysis. Okay, thank you.